Hello friends, welcome to another session of our ACE accounting exam series. Today's topic for discussion is going to be Dissolution of Partnership Firm Part 1. In this session, we are just going to learn how to prepare the realization account when there is a dissolution of the firm. Now here first we will understand the steps. I'm going to give you the steps you need to follow, which will be a foolproof step, and if you follow those steps you will not make any mistake. So note down these steps. First step is you will be given the balance sheet. From there first you transfer all the assets except fictitious assets and cash and bank account balances at their book value, means at whatever value given in the balance sheet, to the debit side of realization account. The commonly made mistake is that you confuse what is fictitious asset. Goodwill is not a fictitious asset. Goodwill is an intangible asset. Fictitious assets are in the form of profit and loss account, debit balance, which might be found in the asset side of the balance sheet, or it might be advertisement expense account and so on. And cash and bank account is opened separately when there is dissolution of the firm, and that is why we do not transfer it. Once the step is done, you go to the next step of transferring all outside liabilities at book value to credit side of realization account. So outside liabilities here we refer to the liabilities of the business which it has to pay to the third parties. Here note that when it is Mrs. Partner's loan, so suppose the partner is A, Mrs. A's loan is also an outside liability. That has to be kept in mind. That you transfer book value to the credit side of realization account. The third step is you record the assets realized at the amount that is said to have been realized on the credit side of realization account. You've put those assets at book value on the debit side, the realization amount. What you are realizing would be given in the additional information. At that value, put it on the credit side of the realization account. The next step is they would have given you that the liabilities have been paid at this value. So whatever is that agreed value at which it is being settled, you show the payment to those outside liabilities on the debit side of the realization account. So you see that you have initially taken those outside liabilities on the credit side of realization account. You are paying it off, it comes on the debit side of realization account. The next step that is you go through other additional information. There will be other information like there might be realization expenses paid. You have to account for that. There might be some asset taken over by a partner which would come on the opposite side, that is on the credit side. You would debit the partner's capital account for the asset taken over and credit the realization account. There might be liabilities taken over by a partner. Then you debit the realization account and credit the partner's capital account. So this way you will have to deal with the rest of the items as given in the question. And these assets and liabilities taken over by a partner are to be recorded at their agreed value, whatever value they agreed to take over at that value. The next step is after you have dealt with all these additional information, before closing the realization account, just check whatever outside liabilities you have put on the credit side of the realization account, whether all of them have got paid off. If not, you ensure that they get paid off. That is very important. Then after that also is done, all you have to do is close the realization account, ascertain whether there is a gain or loss on realization. And that amount you transfer to the partner's capital account in their profit sharing ratio. These are the 7 simple steps. If you follow systematically, you will not be making any sort of error in the solution. Now let's solve one question and apply this method. Srijan, Raman and Manan were partners in a firm sharing profits and losses in the ratio 2:1. On 31st March 2017, their balance sheet was as follows. You see on the liability side, capital account of Srijan and Raman is given. Creditors, bills payable, outstanding salary. These 3 are the amount of outside liabilities. And there is capital of Manan. One of the partner has a debit balance, so this would appear on the capital account on the debit side, whereas these 2 amounts would appear on the credit side of capital account. Rest of the amounts are plant, investment, stock, debtors, bank and profit and loss account. So out of these, plant, investment, stock and debtors would come into the debit side of realization account at these book value. These outside liabilities would come on the credit side of realization account at book value. Bank account is going to be separately opened with the debit balance of 10,000 And this is the profit and loss account, which was a fictitious asset, which was not to be transferred to realization account. Where do we transfer it? We transfer it to the debit side of partner's capital account in the profit sharing ratio. So this is how the items are going to be dealt with. So I hope it is clear. Let's look at the additional information given. On the about date, they decided to dissolve the firm. Srijan was appointed to realize the asset and discharge liabilities, and Srijan was to receive 5% commission on sale of assets except cash and was to bear all the expense of realization. So here, Srijan is to be given a commission, which you have to remember to calculate once you have recorded all the assets realized except cash on the credit side of realization account. On that amount, you calculate 5% and put it on the debit side of realization account as realization account debit to Srijan's capital account for the commission given to the partner. The next, assets realized have been given. These amounts come on the credit side of the realization account as assets realized by bank. Investments were realized at 95% of book value. So whatever is the book value given in the balance sheet, 95% of that you will add to this value of asset realized. The firm had to pay 7,500 for an outstanding repair bill not provided for earlier. So this is the liability of the business which was not provided. Obviously the firm is being dissolved. Now it has to be paid by the firm before closing of the business. So it would be debited to realization account and the credit would go to the bank account. And next one is a contingent liability in respect of bills receivable discounted with bank had also materialized and had to be discharged for 15,000. Now there was a contingent liability, means it was a liability which depended upon occurrence of an uncertain future event, and in this case it was a bill receivable which was discounted with bank. So if the person who had to pay, that is the debtor, paid it on the due date, then nothing would have been payable by the firm. But because it got dishonored, now the bank is going to collect that amount from the firm because firm had discounted that bills receivable. And therefore, now amount is going to go out from the bank account and it is going to be debited to realization account. And last one is the expense of realization amounting to 3,000 were paid by Srijan. Now important point, Srijan has been asked to bear all the expense of realization and he only paid it. So it doesn't matter, this particular amount will not come into the books of the firm here at all in the realization account. That has to be kept in mind. So this you can ignore because he is being remunerated to take care of all the activities and the expenses and he paid it as well. So nothing in the books of the firm. So I hope it is clear. Now we will put this down in a realization account. We prepare a realization account like this with two amount columns, debit and credit on either side. First step, transfer all the assets to the debit side of the realization account, to sundry assets at book value. So what are the assets we have? We'll write it down individually in the inner column. To plant account, 2,20,000. Investment, rupees 70,000. Stock, 50,000. And debtors, 60,000. The profit and loss account is a fictitious asset, so it will not be transferred. The total of this 2,90,000 plus 1,10,000 is 4 lakh in the outer column. First step done. Second step, transfer all the liabilities to the credit side of realization account, the outside liabilities that is. So we write by sundry liabilities because there are multiple items here. So the first one we have is the creditors of 75,000. We have bills payable of 40,000 and there is outstanding salary of 35,000. So total of this is 1,50,000 in the outer column. Second step done. The third step is of the assets realized. So going to the additional information, we found that in the second adjustment that said assets were realized at. So we will write that as by bank account. for the assets realized. They said we realized certain amounts on plant, that is 85,000, stock 33,000, and then debtors 47,000. And the next third additional information was given, investments were realized at 95% of the book value. So investment. Go to the balance sheet and look at the investment value. What was the investment value? Investment was at 70,000. So you have 95% of 70,000. That is the value which is being realized, which means it is 66,500 which is being realized. So total of the amount realized is 2,31,500. So that is dealt with assets realized. Now let us look at all the information given. First one has not been dealt with. Srijan was given a commission. So we have to pay commission to Srijan. So to Srijan's capital account, on account of commission, he is supposed to get 5% of asset realized, which is 2,31,500. So calculate that amount. It comes to 11,575. And the next, second one we have already taken here. Third one, investment realization taken here. Fourth one, the firm had to pay 7,500 for outstanding repair bill. So this is for the payment to be made. So realization account debit to bank account. First one is an account of outstanding repair bill of rupees 7,500. So we will pay it off. Then there is a contingent liability in respect of bills which were discounted. So bills receivable dishonored had to be paid off. So we are going to pay 15,000 on account of that. Then the expense of realization, as we said, as he's been given commission and he's bearing it and he also paid it, that has been given. So that is going to be ignored. Now we have taken care of the additional information. Now the next step. What are we supposed to do? Look at the liabilities and check whether they have been paid. From the additional information, nothing was given about whether creditors, bills payable, outstanding salary were paid. So we are supposed to take this and make the payment of the same at whatever is the book value. We assume that the entire value, whatever is there, that is being paid. So we put it here to creditors account. We will pay off 75,000. Bills payable 40,000. Outstanding salary 35,000. Now you have dealt with everything. From the balance sheet amounts taken, from the additional information dealt with everything. Finally you also checked and paid off the liabilities which were not specifically given. So these were the entire payment made. So what is the amount here? So 90, 130, 165, 165 plus 7,500. 172,500 is the amount which got paid. Everything done, we just close the realization account. In this case, we find that the debits total is more. So we write the total here. The total of this is 5,84,075. Write it on the other side. 5,84,075. So find the difference, subtract these two amounts, and you get the amount of loss on realization of 2,02,575. So that would be by loss transferred to the partner's name to their capital account. So Srijan's capital account to Raman's capital account and to Manan's capital account in their profit sharing ratio. Profit sharing ratio was 2:1. So divide the 2,02,575 in that ratio. It comes to 81,030 for Srijan and Raman and 40,515 for Manan. So this is how we prepare in such simple step realization account. So thank you for joining me today. Please stay tuned for the next session where I will show you how to prepare the capital account of the partners. So stay tuned. Bye-bye.